शर्ट को बना दे स्पेशल और फैशनेबल। फॉक्सेंट, न्यू फैशन वेयर फॉर मेन।
Good afternoon and welcome. You're watching Bloomberg Quint Live. I'm Alex Matthew and these are the headlines at 12. It's not the best start to the expiry week, with both the benchmark indices trading with cuts of over 0.5% each. PSU Bank Index falls for the 6th session in a row. In fact, all sectoral indices decline. PSU banks extend losses after more lenders disclose their exposure to the Punjab National Bank fraud. Tata Steel is a top nifty loser after it puts in a bid of 45,000 crore rupees for Bhushan Steel. Analysts fear that the amount might just be a little too high. And Natco Pharma gains after the US FDA completes the inspection of its Mekaguda unit with 0 observations. And with that, it's over to Darshan Mehta for Hot Money. Darshan?
Thanks, Alex. Hello and welcome to Hot Money on Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Independent investment advisor Vivek Mavani, Sameer Kalra of Target Investing, and Urmil Shah of IDBI Capital joins us on the show. Today on Hot Money, we'll discuss stocks like PNB, Apollo Hospitals, V-Guard, and a top bet from the IT sector. Let's start with the first stock, and that is PNB. Already the counter has been hammered out of proportion. It's down almost 35 to 40%, actually more than 40% from the recent highs. It's trading at fresh 52-week low. What should one do? Trading at almost a subpar book, given the fact that the drop has come in. What should one do? Is it a time to accumulate PNB or is it a total avoid? We'll ask our guests. So, Urmil, I'll start with you. PNB almost down 40%. Should value investors start accumulating PNB or is the drama yet to unfold and they should totally avoid it?
So, clearly a no to that. We believe at best it can be a trade, but definitely not an investment option. And more importantly, what the market is doing, we believe that it's a good time to buy good quality private sector banks or NBFCs. So we have been recommending HDFC Bank and IndusInd Bank amongst private banks, and also the housing finance space. So as regards PNB, we think that the recent issue will not just have a balance sheet impact, it should definitely also have a business impact going forward. So we clearly are very negative on the stock, and it's a complete no from an investment point of view.
So is it only on PNB or the entire PSU? Because most of the PSU banking space are trading at fresh 52-week low. So would you share the same view on the other PSU banks also at this point of time?
We would only want to look at SBI and no other public sector banks.
Okay, so it's a clear negative that's coming in on PNB from Urmil. And Sameer, what's your view? Is it a good time to accumulate PNB?
Not a good time right now, but I think there'll be a further downside. See, this recent scam which is revealed, everyone has forgotten what the NPA norms changes will affect the whole system as such. So if you take PSU system now, they have to reveal the NPAs real time. So either it's 6 months you get it sorted out, or it goes to IBC. So eventually it gets revealed. On the weekly basis, any default above 5 crores have to be revealed on RBI. So now I think the next step will be the step which SEBI was keeping hold on, is the revelation of that default, because RBI will be getting that data on weekly basis. So I don't see any hurdle over there of not disclosing it if the company is listed. So that will give another downside to these PSU banks, whether it's PNB or any other PSU bank. So I think next 8 to 9 months, I think a further downside will be there, which I would like to start buying over there.
Okay, so you would wait for a further correction that will come in. And any of the PSU banks that when this correction comes in, which would be the one that you would look at?
So I would rather look at SBI, Vijaya Bank, even PNB, because see, whatever has happened, it's already taken into the book. and it's already taken into the price. Now the further NPA recognition cleans everyone's book. So the only point is who's left out of that cleaning. I think PNB will be the one where I even start looking at.
Okay, so that's the view that's coming in on PNB. And Vivek, would you buy, accumulate PNB or any other PSU banks, or it's a clear avoid as our guests are
I think the whole sector is an avoid. I just recollect, Warren Buffett has once said, as far as corporate problems are concerned, it's like finding a cockroach in a corner and you try to clean, and there are a whole lot of more cockroaches which come out. And the events over the last few days or even last few months, as far as the PSU banks are concerned, as regards NPAs, and now this clearly was an irregularity in terms of absolute scam, forgery, fraud, whatever names you can give it. So it actually speaks a lot about the governance in the PSU banks, lack of detailed audit, which was clearly not able to point this out or bring this out, and we don't know what has happened in PNB. Could have happened, or it still probably continues as we talk now in some of the other banks also. We really don't know. That's one side of it. And every day more documents incriminating, more arrests, more revelations, and all of it. It clearly can't get over in 4 days. Probably this is going to be a prolonged thing, and news flow is clearly going to be negative. So one is as Urmil and Samir mentioned, the balance sheet impact is obviously going to be upfront, probably in the fourth quarter itself. The business impact will pan out over the next few quarters, but it's clearly a no-go area, because how do I now value a PNB or, as a matter of fact, any PSU bank? Where is the book value? Because I don't even know what is the book value. If RBI forces PNB to take this entire 11,000 crore write-off, plus the other NPAs and mark-to-market provisioning on account of rising interest rates, well, PNB will probably be left with no book value, or in the entire net worth getting eroded by March. How do I value a company which doesn't have a net worth? And we still don't know whether this is end of the problem. We still don't know whether this is end of the tunnel. So PNB being a proxy for the large PSU banks, barring SBI, I think it's a no-go area. Even SBI at 260, I don't think is a attractive bet. Probably SBI itself could drift to maybe 225 or less than 250, 225, 250 range over the next few weeks.
Okay, so that's the view that's coming in on PNB and the entire PSU banking space. All our guests do believe that it's actually not the best time to start accumulating. There could be more downside risk, and among the PSU banks, probably if there is any accumulation, SBI seems to be the consensus bet at this point of time. Rather, the consensus bets in the banking space would be the NBFCs and the private banks at this point of time. So that's the view on PNB and the PSU banks. Apollo Hospitals is the next stock that we want to talk about. Today it's gaining. It's up almost 2%. The last time it's almost 4%. But post a decent set of numbers and good management commentary, the counter was down significantly. Is it a good time to start accumulating Apollo Hospitals? We'll ask our guest. Samir, I'll start with you. Apollo Hospitals, no doubt it's no longer cheap. It's the largest hospital in the company. It trades at a significant premium to others. But is it a good time for someone to enter Apollo Hospitals?
So I'm bearish on Apollo Hospitals. Okay. What has happened, if you see last 3-4 years, the revenues have almost doubled. The profits are same. So it was a 305 crore profit in 2013, and 2017 we stand at 290. The reason being the margins have taken a hit. So it used to give a 16 to 17% margin, which has come down to 12% margin. Now the second part is the debt part. So earlier they used to be like 0.3 debt to equity. Now they've come almost to a 0.9. So that has increased the interest cost for them from 30 crores to a 200 crores kind of a system. So that has hurt the profit system. So I don't see anywhere that deleveraging taking place. So I see even a further, and this debt is mainly working capital debt. So as even the revenues grow, the working capital debt requirement will grow. So I see a further downside to it, because it's already getting such a high valuation of what I really don't know.
Okay.
So I rather be a negative on this.
Okay, but do you like the hospital space? Anything else in the hospital space that you like?
See, now whatever has happened, I think a Fortis is something people can look at. Because see, whatever has happened, the main problem of the governance or the promoters, that has been distant. I think another 3 to 6 months, this all will be sorted out. In what way, and post the SEBI investigation into the taking out the loans and everything, that is on the sidelines. But I think operationally, even if something takes place by the new board, or if there's a certain kind of acquisition or kind of a merger, because now they are going asset heavy. So I think it'll be better off to play through Fortis in a hospital space rather than Apollo. Right?
Okay, what about you, Urmil? Would you tell your investors to enter Apollo hospitals, or is there a better choice in the space?
So the space entirely we do not like it, purely because it being very capital intensive, long gestation, and not even double-digit ROE. You have many other businesses like say even Power Grid, which has a relatively better ROE, and it's still capital intensive, but you have a much better visibility. Nevertheless, Apollo Hospitals is the best managed hospital group in India. And yes, the last couple of quarters, the performance has been better. But as you just discussed that the Mumbai unit needs to turn around for the margins to improve, which looks at least a 1-2 year away. And valuation at 45 times FY19, over 30 times FY20 with a ROE of single digit, that doesn't augur well for an investment as such. So if somebody is holding, one needs to have a really long-term view. But for an fresh investments, it's a no.
Okay, so that's the view. Vivek does not cover it and does not have a view on it. So we'll move on. So that's the consensus view that we are getting in. It's not an attractive sector at this point of time, but Samir does believe that if it has to be played, Fortis is a better bet that someone should take in the hospital space. So with that, we'll move on to the next stock, and that is V-Guard Industry. The counter has been buzzing. It was up significantly on Friday. Today, it's marginally flat. But what's driving the rally in V-Guard? We'll ask our guest. Vivek, I'll start with you. V-Guard, any view?
Well, a couple of things. You can't deny the credit to the management for having done a fabulous job of moving from their core business of stabilizers, what used to be a few years ago, to a diversified consumer electricals company. Now launching even kitchen appliances and whole host of other small appliances that go in the in any household. That's number one. Diversification away from their markets in South, and now I believe about 30% of their top line comes from non-South, that is West, North, etc. So next couple of years clearly is going to be, there seems to be visibility based on their track record of having delivered above 20% growth rates. Even on a higher base, I would feel confident for the management to deliver 20% over the next 3-4 years on back of distribution expansion, new products, aggressive marketing, new brand campaigns, etc. Obviously, it's going to come at a cost, but operating leverage and scale efficiencies will ensure that about 20% top line growth and perhaps about 22-23% earnings growth is quite doable over the next 3 to 4 years. That's one side of it. So it's a good story which has come up over on the consumer side in the last few years. What is not good about it is only the valuations. At about 40 times financial year 20 earnings, about 40 plus times about 19 earnings is clearly aggressive. No doubt the company does deliver about 20% return on capital, return on equity, but I believe valuations will correct over the next few months. There's likely to be an equity dilution, although we are not very sure because management has taken approvals for raising 500 crores and they haven't clearly spelled out. They have said combination of debt, equity, so one doesn't really know how much of dilution will happen. Is it going to be fully debt? So it also probably raised the question mark that maybe the growth may come with inadequate cash flows, obviously because of a lot of upfront investments that will go into new products and new geographies. So I would wait for a correction, wouldn't buy it now, but maybe if it were to correct to less than 30 times earnings on a forward basis, maybe I'll consider.
Okay, so that's the view. Urmil, you seem to be bullish on V-Guard. What's the rationale?
Yeah, so we are bullish on well-managed B2C companies, and in addition to what Vivek said, that the non-South business already 35% of the revenue and growing very well. Plus, they have done a rebranding to actually transform themselves as a consumer appliance company as well. All this will bring results in FY19 and 20. We believe that the consensus expectation of a 26% earnings CAGR does have upside because the non-stabilizer segments have a very low penetration by the company. Also, if you see, they have 105 crores of cash in the balance sheet, and based on what they raise, it could lead to M&A in this space, and that could further provide a uptick to the growth. So we believe that the earnings growth of 26% has upside, and they are doing a ROE of 26-27%, which is also very strong. So at 35 times FY20, it's expensive for a reason that the growth is very strong and has upside triggers. So we remain positive on this.
Okay,
stock.
do you have active coverage on V-Guard?
No, we do not actively.
You do not actively cover it. And what about you, Samir? Any view on V-Guard?
So I'm neutral to bullish on it. Neutral given the valuations and what has happened in the last 3 years. They've deleveraged their books. So they used to have around 100 crores debt, which has come down to 5 to 4 crores now. The second part which has played, as he said, stabilizer was the main cash flow generator for them. They've utilized it into a water heater and another 2 segments, which has come to a 300 crore kind of a revenue annually for now annual basis. Now they have opened up switchgear category for themselves. That in last 2 quarters have become around 70 crores. So they are focusing it to become another 300 crores in next 2 years. So they plan to launch every new category in every 3 years now. So that growth is very optimistic when you enter that kind of, but the only concern I have is whether they start using debt to fund it. So when you start debt to fund all these kind of expansions, because these are highly competitive areas, the margins are very thin. So any kind of downward pressure to your margins will start hurting your cash flow generations. So where the valuations actually take a hit. So I want to see how they fund the growth here on post the raising approval.
Okay, so that's the view that's coming in on V-Guard Industries. Urmil is rather bullish on it, but I think the consensus that's coming out is that valuation from the other 2 guests at least is that valuation is expensive. There's no doubt about the management quality and the business prospects of the company. So I think valuation seems to be the only concern that our guest having on V-Guard Industries. And finally, in a scenario where there is significant amount of selling pressure across the market, there seems to be a little reprieve, and money seems to be again flowing back into the IT sector. So IT companies came out with a decent set of numbers. Is there scope now to increase exposure or put more money in the IT sector? We'll ask our guest. So Urmil, I'll start with you. Now the fact that there is significant amount of correction, the Nifty IT hasn't fallen so much as the others, it's considered a safe haven. What would you bet on in this IT sector? Is it a good time to start investing in this IT sector? And if yes, which are the companies that you like?
Yeah, so we have been recommending to selectively invest in the sector for almost 3-4 quarters now. So clearly the signs of large deals coming in have started kicking in, and more importantly in the digital space. Companies like DCS have done the best as that regard, and if you see the Q2 and Q3 numbers, most of the companies have met the revenue growth expectations, but importantly beaten as regards the on the upside as regards the profitability. So they have been able to manage the margins very well. Now FY19 outlook clearly looks better based on the deal pipeline and the deal wins, especially in the digital space. From that point of view, we are relatively positive. If we look at the valuation as well, most of the companies are trading near to the median 1 year forward PER in the last 3 years. So from that perspective, we continue to like the sector. Amongst the large caps, we like HCL Tech, followed by TCS.
Okay.
And we believe that in the mid caps, it's either be in the ER&D space where we like Cyient, or we really like companies which are delivering very strong growth in the digital solutions. So we also like L&T Infotech.
Okay.
So these are the top picks in the sector.
Okay, so 4 picks coming in from IDBI and Urmil include HCL Tech, TCS, Cyient and L&T Infotech. Samir, good time to start investing in IT and FES, which company?
So I think now if you see, IT was really good to invest in year back, especially in Infosys when all this was happening and everyone was pointing out at the corporate governance and all. See, over there we were a big buyer in our portfolio for Infosys. So what exactly happens is, see, since the time the business is still cash flow generating. It's not that the cash flow has gone out of the business. It's just that when the bull rally comes in, everyone goes towards more active stocks and less towards the defensive ones. So now where a certain kind of consolidation is taking place, people are moving their money towards these IT and pharma companies. So Infosys is our main pick out here, given the reason that they had a bad last year on the base of numbers, on the base of attrition. So the attrition part is the main important part for any IT company to be judged by. So last quarter they showed a drastic improvement from a 17% to a 15% on a standalone, and there the cash flow generation was much higher than what regularly they get. That was again because of the US agreement which they did, which gives them that 1% extra margin every quarter from now onwards. So that gives a differentiation compared to a TCS which hasn't gone through that agreement right now. The second part is the CEO coming in, so you'll see a lot of digital focus now. They've had a very big healthcare agreement now. So I feel Infosys is the one right now where we feel the money should be put on.
Okay, so Infosys is the topic of Samir and Vivek. Good time to put money in IT?
Oh yeah, of course. So IT clearly is now a buy on declines for whatever declines you may get among those individual stocks. Rationale basically being that whenever the US economy has done well, the Indian IT stocks seem to have had a little higher or accelerated earnings growth, and it is clearly visible from the outlook and the guidance that companies have given out in the last 2 quarters, be it a TCS or a Tech Mahindra or HCL Tech. Infosys and Wipro have their internal problems to deal with, but there clearly seems to be a sense that those problems seem to be behind it and growth momentum will return. But at this point of time, a Tech Mahindra and a TCS clearly look good from that point of view. As Samir mentioned, that business may have slowed down, but they still are massive cash generating machines, especially the TCS, and huge amount of surplus cash and bank balance on the balance sheet even after the buyback and liberal dividends and so on and so forth. Among the mid caps, one really needs to focus only on those companies which are specialists in their domain. I mean, generic companies which are across all verticals, which are across all domains, really don't make sense from the mid cap point of view, because large caps are doing that anyway. Then it makes sense to be in large caps where the valuations are very, very reasonable. Mid cap, the key thing is to invest in specialists which will deliver consistent and long-term growth. At this point of time, I don't really have a view on mid caps, but as far as large caps are concerned, TCS and Tech Mahindra beyond doubt for me would be the picks.
Okay, so that's the view that's coming in on by Vivek. TCS and Tech Mahindra are the counters. So if you sum up what's happened as far as the IT space is concerned, the consensus sense that we're getting is that it's a bullish call. It's the right time to start investing. HCL, TCS, Cyient and L&T Infotech is something that Urmil spoke about. Infosys is what Samir spoke about, and Tech Mahindra and TCS is what Vivek spoke about. So that's the general view that we are getting in on the IT space. Okay, with that, it's time to wrap up Hot Money. Urmil, Vivek and Samir, thank you so much for joining me on the show. With that, it's a wrap on Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.